on my opinion, I think a leader has to be a good friend, or let's say a best friend. And in order to lead, I feel the leader has to do something new with their employees. For example, I get several feedback from my best friends who are working. They would always say that today my manager just passed by my office and he just said hi, for example, or good morning, or you're doing a great job. She called me and I was like, is everything okay? It's your birthday today? Is it something? What's happening? She just told me that my boss passed by and she just said good morning, you know, or you did a great job. So that's something very, very important in order to lead, because you want them to love you, you know, not like be there just to say, okay, my boss is here, let me just work and do my routine and just leave. Because we don't want to just be like employees at the end of the day, just filling the gap or like filling the hours and then just head back home. You want to feel like you're going to your second home, right? You feel like, okay, I'm going to go to the best leader or like to the best boss next day.
I think being human is super important. We forget the human component of being a leader. And a CEO or a manager is not necessarily a leader, and we all have to aim to be that.
Absolutely.
To be, like you said, someone who supports and invests in their employees.
Absolutely.
That being said, are you ready to introduce the next panelists?
Let's go. So let's proceed with the topic that is burdensome for many startup founders, securing finance for their ventures.
كل الشكر لضيوفنا من الرؤساء التنفيذيين، والآن ننتقل إلى موضوع يمثل عبئاً على عديد من مؤسسي الشركات الناشئة، هو تأمين التمويل لمشاريعهم. في محادثة يديرها نور الشوا المدير العام لمنظمة انديفر الإمارات، سنسمع من مها الفهيم مؤسس شركة هاي واتر فينتشر بارتنرز، وأحمد النقبي الرئيس التنفيذي لبنك الإمارات للتنمية، وسامر شغير المدير العام لشركة الهلال للمشاريع الابتكارية، عن خيارات التمويل المختلفة المتاحة لرواد الأعمال في السوق اليوم.
In a conversation moderated by Noor Shawwa, Managing Director, Endeavor of the UAE, we will hear from Maha Al-Fahim, the founder of High Water Venture Partners, Ahmad Al-Naqbi, CEO of the Emirates Development Bank, and Samir Choucair, the Director of CE Create, about the various funding options that are available for entrepreneurs in the market today. Noor, please welcome your speakers to the SEF 2021.
تفضلوا.
Good morning, everyone. What I'd like to do is just to take a very, very quick scan of the audience. How many entrepreneurs who are running businesses right now are in the audience? Okay, and how many aspiring entrepreneurs that are planning to start a business? Okay, so it's an even split. Okay, how many people have raised funding, whether it's debt or finance? Okay, so let me start by introducing our panel, and then we'll go into it. We'll start, ladies first. Maha, maybe you can introduce yourself and your company.
Sure, thank you, and it's a pleasure to be here in front of you all. So my name is Maha Fahim, and I am the founding partner of High Water Venture Capital, a VC firm that's established based in Abu Dhabi. I also manage the VC arm of my own family office.
And then Samir.
Is there another mic?
Are we missing? I think we're missing one mic.
I think one of the previous panelists might have taken it home with them. No?
Go ahead, Samir.
My name is Samir Choucair. I'm currently heading the venture building and incubation platform at Crescent Enterprises. I also sit on the investment committee of the Dubai Angel Investors, where I've been an active member for the past 4 or 5 years. So I like to think of myself as a startup ecosystem enabler in many ways, from funding, I guess, as per today's topic, as well as mentorship and support and advice and participation in a lot of the startups that we invest in and work closely with.
And then I think we have a microphone.
Sharing is
More COVID friendly this way.
Yeah, absolutely.
Go ahead.
You guys can hear me, right? Okay, 1, 2, 3. So I'm Ahmad Naqbi. I'm the CEO of Emirates Development Bank. And Emirates Development Bank has just recently, last May, relaunched this strategy to focus on the economic development of the UAE. Specifically, we focus on 5 key sectors. The sectors are infrastructure, advanced technology, manufacturing, healthcare, and food security. We focus on all segments of the market in different parts of the business life cycle. So going from startup phase, which I believe many of you are here today for, into small business and medium business and large corporate business. We give finance, but we give finance with a purpose. So we're not like a typical bank. We're not like a commercial bank. We actually have economic metrics that we follow, not return on investments. And we look to finance interesting initiatives and projects in those 5 key sectors to help develop the economy of the UAE.
Great. So just as a check, Najla, can you hear us well with the sound? Okay, because the sound is not very clear from here. So my name is Noor Shawwa. I manage an organization called Endeavor in the UAE. It's a global organization. We work with entrepreneurs who are past the startup stage, that are in a later stage, that are kind of taking their companies to the next level. So one of the speakers that was on the panel before, Mohammed Ballout, is an example of an Endeavor entrepreneur. So I have my job puts me in a position where I work with a lot of entrepreneurs that deal with a lot of issues. One of those issues is fundraising. So for the sake of people in the crowd who are new to the concept of entrepreneurship, what we'll do is we'll just cover kind of what are the basic options you have as an entrepreneur when you're fundraising, and then we'll explore the different routes that you can take and which ones make sense and how to navigate each one. So very briefly, if you are raising a company, you have the option of bootstrapping and funding it yourself and growing it, which a lot of entrepreneurs will tell you is it's a good way to go, but it's a slower way to go, and sometimes you need that financing. The other way that you can go is sometimes you can benefit from grants or different incentives that usually governments have. But when you need to raise funding from organizations or other people, you typically have 2 routes. One is equity, where somebody is giving you money and they're taking a stake in your business. And the other route is debt, where somebody is lending you money and you're paying them back with some interest. And each of these 2 obviously can become a lot more sophisticated. There are a lot of different players in there. So from debt financing, typically people go to banks. And I think we'll go to Ahmad to explain usually what banks look for, who makes sense to go to banks, and also there are different types of banks that have different priorities. And then with equity, we have, depending on your stage, if you're in the early stage, you can go for seed, or you might be raising funding from venture capital, private equity, or other. But let's start with debt, because usually when we're talking about technology, a lot of tech companies tend to just kind of bypass that, which sometimes it doesn't make sense for them to raise funding. But maybe Ahmad, you can tell us what's a typical engagement that you would have with entrepreneurs, just to kind of give the crowd an idea of what would somebody do. Let's say if an entrepreneur comes to you, what's a typical engagement? What are the different ways that you can have, whether it's an opening account or in terms of raising money?
Right. So one, we're open to everybody. So we are the Emirates Development Bank, but we're open to everyone, expatriates included. It's not just for UAE nationals. 2, we focus on the entire life cycle of a company's growth. And so we are, yes, focused on those 5 key sectors, but we've launched just a couple months back our Emirates Development Bank business banking application. And the business banking application is there to address a specific gap that we saw in the market. Post joining this organization and leading the bank, we saw that in discussions with all of our various partners, including Shawwa, that a key issue and a key problem that existed was account opening. So I know that a lot of entrepreneurs and startups have major issues when it comes to opening up their bank accounts. I don't blame the commercial banking sector. I do completely understand the limitations that they have to go through based on the regulations, based on their exposure to dollar, euro, pound, so on and so forth. So we launched this application with the objective of not looking at it from a profitability perspective, because again, as a Emirates Development Bank, we're looking for the development of the economy. We're trying to find the best way to support entrepreneurs. So the application is open to everybody to download. You will be able to get your IBAN within minutes. You can have your account fully KYC'd within 48 hours with some basic documents that are basically uploaded to the application. I'm not exaggerating. Within 48 hours, you can have your account fully opened. The documents that I'm talking about are things like your trade license, shareholder agreement, valid passport copy. As long as all those documents are valid, then you can have that account opened within 48 hours. 100% free to use. So we have none of these charges, none of these like maintenance charges, monthly fees, because again, typically entrepreneurs, when they go to open up bank accounts, if they somehow are able to get that bank account opened with a commercial bank, they'll get hit with all these fees on a monthly basis. And then separate to that, they'll get asked about minimum balances. So we also have no minimum balance requirement. The application is, again, fully free to use for anybody that's starting up their business, and that includes free zones as well, so not just local licenses. If we go up the life cycle, so post entrepreneurs actually starting to generate income. So I want to make it clear, when you're talking about financing and debt, my humble suggestion to you is wait till you are actually a operational business that is generating income and revenue before you even consider debt. Debt is a burden. So Emirates Development Bank does want to ease that burden, which is where we come in, we give patient debt, we give longer tenors. So typically banks, again, will give loans on average to small businesses, which are going to be between 3 to 5 to 7 years maximum. 7 years if you're on the larger side of a business. We go 10 plus years, 10 to 15 years. We also are very competitive on our pricing in comparison to the market, but we're not competitive because we are looking at it from a profitability perspective. We're competitive because we're looking at it from the perspective of how do we pass on our pricing as a bank when we raise funds in order to go back to lend to the market, to ensure that we're borrowing at the best pricing to then pass that on to the startups, to the entrepreneurs, and to the small businesses. So financing is definitely an option, and it's a great option for entrepreneurs once they've reached that stage where they're generating revenue, if they don't want to give up further equity out of their companies.
Great. So, we'll come back. I think there's a lot of discussion points that we can have. Samer, maybe we can start with you, because I know you wear multiple hats. You're with Crescent Enterprises, but you're also one of the founders of Dubai Angel Investors. So wearing the hat of, as an angel investor, can you kind of explain to the crowd who comes to you, what's the typical engagement, what's the typical setup in terms of the type of entrepreneurs you work with?
Sure. So I think, startups like, for example, the ones you've seen earlier today, Kitopi and others you've seen yesterday, really all get started at the angel investments phase, right? Institutional investors, whether VCs or family offices or banks, all have a mandate to invest in businesses that actually have a track record and have the investors themselves have a legal obligation to make sure that these investees are well structured and the due diligence on them has been cleared fully. So it's very difficult for a very early stage, idea stage business or seed or pre-seed stage business to get investment from a VC unless that VC is specifically tailored towards that stage of investment. And in this region, that's still quite rare. And that's where angel investors come in, right? And specifically with Dubai Angel Investors, we are just a group of investors, founders, corporate employees who are interested in building the startup ecosystem and supporting the startup ecosystem. So we got together five or so years ago and put together this fund and started investing small tickets in very early stage businesses with very, very little due diligence. And the idea there is to really give that initial kind of push to startups to get them to the next level where they can at least have a bit more structure before they can start approaching institutional investors and venture capital. In our case, small tickets, $50,000 to $250,000. We try to make the application process quite simple, let's say. It's a big group of, we're maybe 70, 80 members, rotating investment committee, so you get opinions from I guess it's a crowdsourced, you can say a crowdsourced decision on investment, but we try to keep it fairly light. And the idea, again, is to really support and promote early stage, seed, pre-seed, and in some cases we've started moving to Series A more recently with slightly larger tickets. And the idea behind angel investing really is you're putting your faith in the founder and not necessarily the idea. We don't, at that stage, you're almost certain, 100% certain, that the business will pivot and the idea will change at some point in the coming 12 months. So our investment decision is really based on the founding team and the founders themselves, and that's where we put most of our attention when going through the application process.
Great. And then Maha, you recently set up a venture capital firm. Maybe you can tell us about the type of entrepreneurs that you work with.
Sure. So I also wear multiple hats, so I'll explain a little bit more as a VC what we look for. And we're primarily just structured to invest in tech companies that invest across 5 verticals, health tech, ag tech, AI, and fintech, as well as next generation process automation. And as a VC, we also have a region focus, which is something kind of whenever any of you here in the crowd would want to approach a VC, the first thing to look for is what stage are they investing? For us, it's C to B. What region do they invest in? For us, it's the US, actually, even though it's located in Abu Dhabi. And then 3 is the sectors. However, the other hat I want to also kind of bring up here is I also invest on behalf of my family office. And when any family office has some sort of VC arm, whether it's sophisticated, small, highly established, is more often than not, they're strategic investors. They invest because they want to either learn about a new sector or incorporate some of those businesses into their existing operations. So when startups or founders come to me, to the family office, what we often look at is preparation. Have they prepared? Do they know who we are? Do they know why we should invest? And if we can be strategic to them. And I think just homework, regardless of what the business concept is and what the product they're selling is, just seeing that this is an entrepreneur or a founder that has been prepared, we know that this is a sign of success. Whether it's they pivot next year or in the following years, we know this is probably a founder we would like to back.
Yeah, so I think it's really important for entrepreneurs because working with a lot of entrepreneurs, some of the common mistakes we see them making is sometimes they don't see the perspective of the financer and they don't understand the behavior of the financer. Sometimes they would kind of complain that the banks, the entrepreneur would say, well, the bank, I want to borrow money from you, but I have to put collateral, so I have to have money to borrow money, or they would go to the investors and would say they're being too conservative. So I think it's really important for entrepreneurs to understand that the investors or the financiers, whether they're lending you money or investing money in you, they're in the business of managing risk, because in the case of a bank, they have money that's come in either from the government or from people who've put their deposits, and they're paying them interest on it, but then they're lending you that money so that they can basically get an interest where they get a spread, or if it's a development bank, they're not necessarily looking for a spread, they're looking to cover their costs. Investors are either raising a fund that brings other people's money and they're investing in you, or sometimes it's their own family money. So they want to make sure that when they're going to invest in you, that number one is that they're not going to throw that money away, that there's an opportunity for this money to go forward. So they start looking for signs of, do you really know what you're doing? Have you prepared? Because if an entrepreneur comes to them and they're not prepared, usually the investor will kind of start worrying, is this person going to, do they know what to do with the money? Are they going to do the money well? The other mistake that we notice entrepreneurs make, and especially in the earlier stage, they say, well, I need to raise money. I'm going to go talk to everybody. I'm going to go talk to Ahmad. I'm going to go talk to Samer. I'm going to talk to Maha. And that's a big mistake that wastes a lot of time for the entrepreneur and wastes a lot of time for the investors, because there might be, let's say, 50 or 100 entrepreneurs here. Some of them, it makes sense for them to talk to Ahmad. Some it makes sense to talk to Samer. Some it makes sense to talk to Maha. Some it makes sense to talk to none of them and to talk to someone else. So maybe what we can do is we can spend a little bit of time talking about what's your sweet spot, who's the perfect entrepreneur that should come to you, and who should not come to you, to save them time so that they're not knocking on the wrong door and they can kind of put their energy towards the right people.
So we want anyone who wants to come to us can definitely come approach us. But I can talk a little bit about what you shouldn't do if you're going to come in this kind of a situation. So again, it goes back to, there's two things that we look for as a bank when we're going to finance a company. And I'll keep this as simple as possible. One, we look for your ability to repay, the form of repayment. So how do you generate your income, and are you generating income, and how secure is that income? And this can be from the business itself, so we're looking at the business, of course, and studying the business and ensuring that it's generating income. But it can also be from alternative sources. So we understand that as an entrepreneur, you don't necessarily have a business that is already generating income, but you might have other assets that are generating income, whether it's your own personal salary, if you're working and starting a business, or if you own a revenue generating asset, which we could take assignment over in order to have payments against the amounts that the loan requires for repayment. The second thing that we look at is collateral. And collateral is not something that we want to be in the business of, but it is the way that you secure a loan. So what we look at is we see how much do you have that you could put up against this loan, just in case if you were unable to pay the loan and you went through a debt restructuring, you went through essentially the whole process of the bank, would that collateral be able to cover the amount that was given of the loan to start off with? This can be property, it can be equipment, there's lots of different, it can be shares, there's lots of different ways that you could have collateral against a loan. Again, we don't want to ever get to that point. So what we do is we ensure that your source of repayment, your source of income to pay the loan is as good as possible. Now, for businesses that we fund and we finance, again, being a development bank, we give grace periods. So we typically give about a year to 2 years before the company or the business has to pay back anything on the principal. You'll only be servicing the debt for about 2 years, the interest amount. And that allows the business the time and leeway to be able to breathe and grow and start generating income and revenue, and then be able to pay back the loan or the facility. But we typically do that if there's a strong feasibility study and a management team that has a good track record. Because coupled between those two, then we believe that the team can actually deliver on the feasibility study over the course of 2 years and start generating income. Granted, of course, there would be collateral against it.
Okay, so I mean, typically what we hear, a lot of the tech entrepreneurs that need to spend 2-3 years to kind of really develop the technology before they have meaningful revenues to be able to service the debt, it's probably better for them to wait before they come to you, because in the early days, unless they have personal collateral, it makes sense for them to kind of not, it's not the right time.
Absolutely, absolutely. I mean, look, in the end of the day, it's a balance between giving up equity and taking debt. But in your early days, you don't want to be burdened with additional expenses, because that's what debt is. It's an interest expense. It's an additional line item. So if you have someone that believes in your business and someone that's willing to put up capital in order to take equity positions with you, they're essentially sharing with you the risk at no additional burden or cost to the organization. So once you reach that point where your company is essentially operational, up and running, and it needs now the next phase of expansion, that's when I would recommend debt. But for young entrepreneurs just starting their businesses, please do not take debt to start your businesses. If your business fails, you will still have to service that debt. Whereas with equity, if that business fails, it was a risk that the investor knew they were going in with.
Yeah, I think that's a really important distinction. So Samer, I think the sweet spot for entrepreneurs to go to angel investors is when they're at an early stage. They have either an idea where a business, an idea, or something that has some initial traction, where the angel investor has knowledge or connections or ability to add what's called smart money, where they're kind of putting in the money, but they're also adding a lot of value. So it's almost like free labor, but you know they're sharing the risk, but they're also gaining the benefit. So maybe we can start with: are there situations where you feel it's not the right fit for an entrepreneur to come to you before we go into the sweet spot?
Absolutely, absolutely. One of the main questions we ask when we're evaluating a pitch is, what can we, as either as an angel individual or angel network, what can we do for you beyond the money? Why are you coming to us? Forget the money, put the money aside. What else can Dubai Angel Investors do for you? And the entrepreneurs that have done their homework will know exactly what they want from us. You know, you guys have the CEO of this company as part of the network, and I want that company as a client. You guys have access to this market that you already have other portfolio companies in that we can collaborate with. You know, in a lot of cases, in all cases pretty much, an angel is not leading around, but they are one of the, or some of the most important, most critical elements of a startup's success, because of opening doors and not because of the cash that they provide. Countless examples of that in the UAE, you know, including the Kareems and others like that. So to us as angel investors, whether, again, me individually or the network, it's very important to understand what is it that we can bring to the table beyond the money. And entrepreneurs who know this are the ones that get our attention and generally get the most out of early stage investors. Of course, in some cases, when you're when you're at the idea stage, even before angels, you start with friends and family. And with friends and family, it's purely just money. You know, I need money to build a prototype, to get this idea to a demonstrable stage, at which point I'll start raising external funding. But it's that once you start raising that, you know, after your first 100K or so, when you start raising from other angels and networks, it's really important to go to, not waste your time with just any money. It's really important to go do your homework and go to the smart money that can bring much more than the money to the table.
And I think a very important element here is also, it's important to understand that you're dealing with human beings. So, you know, if I'm an entrepreneur and I'm approaching Samer, we might click. You know, I might see that the value that he can add to my business is great, and we might click on a personal level, and we might hate each other, even though he's really well connected. And it's really important to understand that, you know, once you take an investment from someone, it's, you can't, or it's very difficult to fire an investor. So it's really important for entrepreneurs to also do a reverse diligence. So, you know, sometimes the investors make a bet on the entrepreneur. You know, is this somebody that we believe in? That somebody that we believe will be able to work with them? How coachable are they, etc. But the entrepreneur should be doing the same thing when it comes to the investors. And then with Maha, I think you tend to work with entrepreneurs at the later stage where they have some traction and they're looking for further equity.
Yeah. So later, when we say later stage, we're still quite early. We look at primarily seed to B. We don't look much at pre-seed where the traction is not there, because that's not a risk tolerance that we're designed to adhere to. But I think in terms of, like, going back to your question of, okay, sweet spots, who should really be approaching VCs versus family and friends versus angel groups, and a lot of times it's a multifactorial problem really. Sometimes fundraising is more of an art rather than a science, because it has to do with, okay, how much collateral do you already have? If you have a lot, then you can just go to friends and families to get you invested. If you have more time and you're operating in a sector that has a lot of growth potential, then VC is more suited for you. Because by design, like, we always have to think of this person in front of me, are they designed to help me in a way? And if not, can I open their eyes and tell them why they can help me? So by the design, VCs target high growth sectors versus then there are other segments today as well. So we have ex-founders establishing micro VCs where they back other founders from their own sector. So it's keeping an eye for all options, researching all options, and also thinking of how do I diversify the cap table. Again, you don't want to have all the same type of investor in your cap table because you can't fire them, as he said as well. But just to be effective and make sure that you're getting benefits from different sources, diversity to the cap table is quite important.
So I'm getting prompted to close the session. What I would suggest is maybe we'll close with two suggestions that we usually hear mentors give entrepreneurs. One is make sure that you target investors well, deciding whether you're going to go with debt and equity and what stage you're in. Typically, when you're raising money for equity, what we advise entrepreneurs is to kind of get kind of a scan of all of the potential investors and kind of segment them based on three criteria. One is, are they focused on specific industries, and is your industry one of them? Number two is, are they focused on a certain geography? So they might be focused on investing only in the US or Europe, and you might not fit that. And then number three is, what size of investments are they looking for? So if you're looking to raise $50,000, it doesn't make sense to go to a private equity firm, for example. The second tip is, building on what Maha said, fundraising is more of an art, and investing and fundraising is more of an art. So what we see, the more successful entrepreneurs that have raised funding, they obviously have the fundamentals, they have good businesses, they have, they're running their business and they know their business quite well and they can pitch it. But what's important is that they tend to be very good storytellers because, especially,
FOMO.
Sorry?
FOMO is the key word.
Exactly, because you're going, especially when you're going with equity, you're looking at somebody who's going to be taking a risk and betting on you. So you want to get them excited about it. It's the transactional part of saying, we do this, we make this money, etc. You need to also build that story where they can get that excitement and they feel this is the next big thing. This is the next Kareem or this is the next Katopi, and I want to be part of that journey. So storytelling is a very important element of it. So I'd like to take this opportunity to thank our panelists for their contribution, and thank you all for being here.
Thank you.